Hey everybody, welcome to the channel. Today we're going to talk about what every house flipper needs to know about paying taxes. So, if you made money on your flip, that's awesome. Why? Because not every flip makes money. So, if you did make money, congratulations. Now you're going to have to pay some taxes. We'll talk about today when you pay taxes, how much, what you can deduct. We'll go through some other things too. Caution, not knowing the rules on taxes with regard to flipping could be hazardous to your wealth. So, what are we going to learn? What taxes you do have to pay on your profit, the difference between short term and long term capital gains, the individual tax brackets out there for those who are single and married filing jointly, married filing singly, head of household. We're also going to talk about the many tax deductions that house flippers can take. And there's also three ways that you can pay $0 on a house flip. Each one comes with a catch, but I'm going to go through each of those in detail. So, here's a little bit about me. I've been a real estate investor full time for the last 20 years. I am a real estate broker in two states and a serial entrepreneur. I've authored a number of real estate books. I graduated from the Wharton School at the University of Pennsylvania. Elon Musk and I were in the same graduating class. I am totally passionate about investing and sharing what I know because I want you to make lots of money and get out of the rat race. Even if you just sold one house in a year and you work very part time, the IRS considers house flipping as a business. But that can be very good for you because, first off, you want to make sure that you keep track of all your expenses to maximize your deductions and reduce your taxable profit. Now, we want to talk about the difference between a short term capital gain and a long term capital gain. If you own an asset less than 1 year and you sell it for a profit, the profit is considered a short term capital gain, and that is taxed the same as what's known as ordinary income. Ordinary income is like the money you earn from your job. Now, if you own an asset for more than a year and you sell it for a profit, that profit is known as a long term capital gain and it's taxed in a different way. And we're going to go through capital gains tax rates. So we're talking about short-term capital gains. Let's assume that you sold your flip property in less than 1 year. For most flippers, that is the goal. You want to minimize your carrying costs and maximize your profit. Uh, Carrying costs includes things like utilities, financing costs, property taxes, insurance, any other costs of holding the property. So let's assume that you're a single taxpayer. Here are the tax brackets for tax year 2023. You can see that the tax rates in the left hand column begin at 10% and go as high as 37% based upon how much ordinary income or taxable income that you have. Now, the IRS has a progressive scale for taxation. You can see that the first $11,000 of income is not taxed at all. Then the next chunk of income up to $44,725 is taxed at a 12% rate. And then in this example, you see we're looking at a single person who's making $58,000 in a year on ordinary income. Their next chunk of income is taxed at 22%. So you would say that this person is in the 22% tax bracket, but they're not paying 22% on all of their income, just 0% on the first $11,000, 12% on the next chunk of income, 22% up to $58,000. Let's also look at the tax bracket if you're a married couple filing jointly. You see the tax rates are also 10% up to 37%. And now we're going to look at the tax rates if you're married filing separately. And then finally, the tax rates if you're considered the head of a household. Let's examine long term capital gains. What if it took you more than 1 year to sell your property? What do you pay in taxes then? I'll give you an example. These three brothers who are first time house flippers spent about 48 weeks working on the property. Then they finally put it on the market and they procured a buyer. Now they asked me for some advice and I looked at the contract And I said, if you sell your property at least 1 year and 1 day after you bought it, your long-term capital gains will be only 15%, versus if you sold it sooner than that, you would pay the short-term capital gains or ordinary income tax rate. I told them to go talk to their accountant because I am not a licensed tax advisor. They did, and they came back and they said, yes, we actually want to change the contract and negotiate with the buyer to have the buyer close 1 year and 1 day after we bought the property. So that's what they did. And they, instead of paying about 24% in taxes, they paid only 15% in long term capital gains tax. So, what do I mean by long term capital gains taxes? First off, if you earn very little money, you pay 0% long-term capital gains. Let's take a look what I mean. Low income earners can pay 0% in long-term capital gains tax if, as a single person, they earned less than $44,625 in 2023, or if they're married filing jointly, if they earned together less than $89,250. So you see, there is a way to pay 0% long-term capital gains tax. Now, I want you to be really profitable, so we get into the capital gains tax of 15%, which applies to most people. If you're a single person and earning between $44,626 and $492,300, you're only going to pay 15% of your capital gain. So, for example, if you earned $100,000 in long-term capital gains, you would pay $15,000 in taxes, and you get to keep the other $85,000. So this is what most people will pay. Now, the very ultra high income earners pay a max of 20% in capital gains tax. So if someone earned, let's say, $1 million in long term capital gains, they would pay $200,000 in taxes and get to keep the other $800,000. Can you pay $0 in capital gains tax on a house flip? Yes, there are three ways to do it. Each one comes with a catch. I'll explain. The first has to do with your principal residence. There's this thing known as the IRS Section 121 exclusion. If you've lived in your primary residence for at least 2 years out of the last 5 years and you sell the property, if you're filing as a single person, the first $250,000 in capital gains is tax free. If you're married filing jointly, the first $500,000 of capital gains is tax free. And when I say two of the last 5 years, they don't even have to be consecutive years. For example, you could have lived in your primary residence in 2019, then rented it out in 2020, 2021, and 2022, and then lived in it again in 2023. And if you sold it in 2024, well, you have technically lived in it 2 out of the last 5 years. And so you would not pay any capital gains tax on the profit, as I described. A second way to pay nothing in capital gains tax has to do with an offsetting capital loss. So let's say that you flipped the house in less than 1 year and you made $90,000 in profit. Now, let's say in the previous year you had day traded some stock, but unfortunately you lost $90,000 through those day trades. Well, you would have had a $90,000 short term capital loss, and it would completely offset the $90,000 short term capital gain. So technically, you would not pay any tax on the profit from your flip. The third way to pay nothing in capital gains tax on a flip is really by doing an IRS Section 1031 tax deferred exchange. Now, there is a catch here, and that is that you can't really do this on a traditional house flip. The 1031 exchange basically indefinitely defers the payment of taxes when you're selling an investment property and using the proceeds through a qualified intermediary to buy a like kind property. In some cases, it can even be a business or something like that. So I'll explain. So let's say that you owned a single family home and you rented it out for a long time, at least several years. Then you decide to sell it and you did a 1031 tax deferred exchange. An intermediary took the money and held on to it, and then shortly thereafter, you bought a substitute or replacement property with those proceeds. Now, you don't have to pay any capital gains tax on the sale of the first house because you use the proceeds to buy another rental property. Now, you don't have to pay any capital gains tax at all unless you sell the replacement property. But why would you? So, what many people do is they just own the replacement property or continue to do 1031 exchanges until they pass away, and then their heirs would receive the property at a stepped up tax basis, which means technically that no capital gains tax would have been paid at all. You can check out my blog or talk to your tax advisor for more information on a 1031 exchange. Now, we're also talking about what tax deductions are available for flippers. You want to make sure that you record all of your expenses so you can maximize your deductions and minimize your profit. Your closing costs are a tax deduction, whatever you paid to buy the property, like title insurance and realtor commissions, transfer taxes, and things like that. Your loan costs, assuming that you got a loan, including the appraisal costs, fees, and interest, those are tax deductible. Construction materials, of course, if you're buying drywall or cabinets or sinks, light fixtures, paint, you name it, those are tax deductible. Labor. So let's say you pay a contractor to paint the walls. The cost of that labor is tax deductible. However, if you painted the walls yourself, you cannot deduct that as an expense. Okay. Utilities like water, sewer, electricity, natural gas, those are all deductible. Your property taxes during your time of ownership, those are a legitimate expense. Professional fees, those include appraiser fees, surveyor fees, lawyer fees, accounting fees, bookkeeping fees. All of those are tax deductible. Travel is also a legitimate deduction. There's two ways to um, deduct travel expenses. One is the actual travel expenses, so the lease or car payment, the interest on it, and then also the gasoline costs and maintenance costs. More people, though, and myself included, will track mileage. And so what happens is you can deduct the mileage. I use the Mile IQ app. And in 2023, the IRS lets you count 65.5 cents per mile as a deduction. In 2024, it's 67 cents a mile. And so what happens is anytime I took a trip to the property or a trip to go explore potential future properties to acquire, that is considered a legitimate business trip. Finally, the last tax deduction available for flippers is depreciation on equipment. Your large tools or heavy equipment, they can be depreciated on your tax return. Lastly, we're going to talk about when should the taxes on a flip be paid. Well, it's like this. Let's say you flipped a house in 2023. If you made more than $1,000, the IRS actually expects you to pay quarterly tax payments. Um, so once a quarter, you're supposed to send in some money unless you prepaid your taxes otherwise. So when you file your tax return and submit it, let's say April 15th, you owe taxes on your flip from 2023 if you haven't already prepaid at least some of the taxes in via the quarterly income tax payments. Now, I know flippers who didn't realize that they had to pay taxes on their profit. I also know flippers who knew they had to pay taxes on their profit, but they didn't set any money aside in a savings account for future taxes, nor did they pay quarterly income tax payments in advance. And they got themselves into quite a bit of trouble come April 15th the following year. I want you to be smart and realize that, let's say that you made $50,000 in profit on your flip last year, and let's say you're in a tax bracket where $10,000 of that uh, profit actually is not your money; it belongs to Uncle Sam. Well, then really you only made $40,000. You should have set aside that 10,000 or prepaid it in quarterly payments. So listen, everybody's tax situation is different, so consult your tax advisor to know what's best for your situation. Like my Invest and Transform Facebook page, We share lots of free information for real estate investors. I promise you that you'll get lots of value out of what is being posted there. Also, go to investandtransform.com. That's investandtransform.com. That's my website. Tons of free information, a free ebook on creative flipping and how to buy and sell a property with no money down or low money down. We have a very robust blog site at investandtransform.com. And lastly, please check out my latest book, How to Become a Wealthy Real Estate Investor 101 Things You Need to Know Right Now. I promise you'll get a tremendous amount of value. I wrote that book so it could be read in less than 90 minutes. It's one of those books that has tons of nuggets on how to be a better and wealthier real estate investor. Again, I'm Tai DeSa. I am passionate about helping people. Please check out my other videos and go to investandtransform.com.